The Fed's been cranking interest rates 6 consecutive times with a 7 expected in December. Jobs are cooling off. Inflation's starting to taper. Let's talk about what this means in the equity markets.
Welcome to the Trending Report, brought to you by USA Financial. The Trending Report is a bi-weekly show that aims to focus on the trend lines rather than the headlines. Each episode features commentary around the state of the market, as well as other factors that may impact your personal finances. The host of the Trending Report is an investment advisor representative of and securities are offered through USA Financial Securities, member FINRA SIPC, a registered investment advisor. The Trending Report is educational and not intended as personal financial advice.
Welcome once again to the Trending Report, and today we'll be discussing data as it ended November 11th, last Friday. Let's jump right in. Now, as we know, the Feds have been raising interest rates with the idea of cooling off a hot jobs market, as well as getting their arms around inflation and bringing it back down to its 2% target level. Now, inflation hit its highest point in June of 2022 at 9.1%, which is what we're seeing here on the graphic on the lower right-hand side. And June, in terms of interest rates, comes in right here. So we were at our highest point in terms of inflation when we were at about 1.5% or so on interest. And now as interest rates continue to go up, and we are anticipating another interest rate increase in December after 6 consecutive interest rate increases from the Feds. But it does appear that we're starting to get the preferred effect, which is what the Feds are shooting for in bringing inflation back down. We're seeing that over here with current inflation being at 7.7%. Now, there was an interesting article that came out from Reuters on November 7th, talking about corporate America bracing for a downturn with job cuts. And I normally don't read things to you, but it's the bullet point list here of the summation of that article that I think creates the impact to show that the Fed is starting to have an impact on cooling the job market. I'll just rally through this very quickly. Meta, aka Facebook, is cutting over 11,000 employees. Citigroup eliminated jobs in its investment banking division, which is an indication of corporate deal slowdowns. Morgan Stanley has announced a fresh round of layoffs in coming weeks. Intel has stated cutting staff will be key to reducing costs by $3 billion. Microsoft has laid off approximately 1,000 employees across several divisions. Johnson & Johnson's CFO has announced they will be right-sizing themselves. Twitter has eliminated 50% of its workforce. Lyft is laying off 683 employees, in addition to 60 job cuts previously. Warner Brothers plans to reduce headcount by 5 to 10%. Beyond Meat plans to cut 200 jobs. Stripe is cutting 1,100 approximate jobs. Chime has laid off 12% of its employees. Open Door Technologies reduced its workforce by 830 and is now laying off 550 more. Phillips 66 has begun cutting staff at refineries, terminals, and offices across the U.S. Chesapeake Energy is cutting 3% of its workforce and selling its South Texas oil properties. Seagate Technology announced a restructuring plan to reduce headcount by 3,000, and Arrival SA plans to further right-size and may cut up to 30% of its workforce. Now, that's a very different tune than we were hearing a few months back as companies simply couldn't get enough employees. So it does appear that the Fed is cooling off the job market. It obviously appears numerically that they are, in fact, reducing inflation by increasing interest rates. So with that being said, I have reported to you previously that we have seen a consensus from economists that believe that interest rates from the Fed will actually turn the other direction, meaning when they would start reducing rates again, probably about a year from now. Q3 or Q4 of 2023 is the consensus I've read in the Wall Street Journal from economists at this point. With that being said, let's take a look at how the market is responding to all of this. From a capitalization standpoint, the overall total U.S. market looking at macro versus micro, is coming across perfectly straight here. And we're seeing basically the same subsets of capitalization are leading on both macro and micro. We're seeing the mid caps in there. We're seeing the small caps in there. That's really driving the day, so to speak, on both macro and micro. So we are also seeing that the micro column is turning green all the way down the path. So the macro is still indicating or flashing a bearish viewpoint, but the micro is starting to flash bullish. So we'll have to see if it's able to turn things back around. Now, if we look at the sector standpoint, we get a similar but slightly different view. Here, we do, in fact, on the macro side of the page, we do, in fact, have a couple coming in at a full bull, which means that they're green on both the macro and the micro. And in that instance, we're seeing energy at the top of the list. Now, what's interesting is when we come over here to the micro side, energy takes a pretty big dive coming down to the lower spot, but then some REITs, for example, are going the other direction. That's real estate investment trusts are coming up to the number 3 spot. So again, we're seeing green coming down the micro column with the exception of telecoms, which is actually still showing us bear, meaning negative on both columns. But overall, it looks like we are seeing the materials, the industrials, financials, utilities kind of driving the day, so to speak, on the sector side. Now, if we take a look at bonds, here we're seeing mostly corporate bonds leading the charge on the micro side. Again, we're getting a lot of green down the micro, which is good to see. The macro is still hanging back there. On the macro, we're seeing mostly the shorter term U.S. Treasuries, but now on the micro, we're seeing the corporates starting to take over. So there is kind of a turning over taking place in that bond market as well. And then if we look at the overall graphic, so this is the total equities ETF. This is the total bond ETF. As you can see, this is our macro calculation here. We're seeing all red on the bond side. So a macro decline is taking place. We do have a little bit of micro green taking place in the lower right-hand corner, and that's reflecting what's going on as of late. Over here on the equity side, again, we're seeing, for the most part, we are seeing a macro decline, a macro red calc, if you will, from the previous pages. And with the exception of here's our micro green taking place in this area right in here. But it gives you kind of an overall feel of what we're talking about on those previous pages when we're looking at macro versus micro. The overall macro trend continues to be bearish. However, the micro trend is starting to turn. We don't know if that's going to catch hold or not. You can see it was turning back here in this range, and we got a bounce, but then it came back down. So we don't know if this is going to have a similar effect in here, if it's a bounce, or if we're starting to truly turn the corner. Again, relating that conversation back to the Feds, increasing interest rates, cooling off a job market, and bringing inflation down. Is that going to have a permanent effect on the equity markets, or are we simply seeing a bounce? That is yet to be seen.
Thanks again for listening to this episode of The Trending Report, powered by USA Financial. We invite you to visit usafinancial.com to find out more about our work with independent advisors and their clients all around the country. Any projections, targets, or estimates in this report are forward-looking statements and are based on the firm's research, analysis, and assumptions. Due to the rapidly changing market conditions and the complexity of investment decisions, supplemental information and other sources may be required to make informed investment decisions. All expressions of opinions are subject to change without notice. Clients should seek financial advice regarding the appropriateness of investing in any security or investment strategy discussed.